Hi everyone. In this video, I'll be talking about some phrases that are often used in investing. I'll be discussing some phrases that can help explain some trends that can be seen in the markets and some guidelines you may want to follow when you're investing. I must say that these are not strategies or ideas that happen every single time, and if you choose to pursue some of the guidelines I'll talk about today, you are doing so at your own risk. So make sure that you feel comfortable before pursuing some of the guidelines I'll discuss today. So without further ado, let's begin today's lesson. So our first phrase is, buy low, sell high. You should always aim to buy at a lower price and sell at a higher price. Don't wait to try to buy at the lowest price or sell at the highest price to try to make the most profit. It is very rare to be able to buy at the lowest price or sell at the highest price. If you keep waiting, you will eventually be losing money because the asset price might be higher or lower than what you were willing to buy or sell it at. In the long term, markets move higher, which is why it is important to buy low and sell high. This will let you make the most money possible. Short-term investors rely on technical analysis, while long-term investors rely on fundamental analysis. When there's a lot of fear in the market, asset prices come down. This is a good time to buy. However, when people are getting greedy and keep buying stock, which drives prices up a lot, it's a good time to sell. This is where the phrase comes from. Buy on fear and sell on greed. People that are bullish or bearish on assets will make money, but people who are greedy, emotional, impatient, or forget their original trading plan will get slaughtered. This is where this phrase comes from. Bulls and bears make money, but pigs get slaughtered. Pigs will lose money heavily. This is why it is important to not be greedy and always remember to develop and stick to your trading plan. Our next phrase is, cash is king. There's never enough money for investing. So when money is available, take it, whether you need it or not. Because when money is needed, it can be very hard to get. A couple of ways you can get money right now are first through creating a margin account with your brokerage firm. A margin account will let you borrow money from your brokerage firm to use against your investments. Another way to get money are through credit card checks. Furthermore, another way to increase money for investing is through a line of credit. There are two types of lines of credits. You can take out both a secured and unsecured line of credit. A secured line of credit has collateral, while an unsecured line of credit does not have any collateral. However, an unsecured line of credit requires you to continuously pay back the money over a short period of time. It operates very similar to a credit card. Both types of line of credits can help increase money which you can use for investing. Lastly, another way to make money is to obtain a pattern day trader status. You can obtain this status by completing at least 4 or more trades within 5 consecutive business days. You must have a margin account to obtain this status, and this status will allow you to receive 5 times the amount of money from a brokerage firm compared to if you didn't have the status. If you didn't have the status, the brokerage firm may only match your investment. But with this status, they will give you 5 times your investment. Our next phrase is, the market goes up in an escalator and comes down in an elevator. This is a common phrase that is used in the markets. Take a minute and think about how an escalator and elevator move. An escalator moves diagonally up or down slowly, while an elevator moves up or down, but in a straight vertical line. So the phrase is, the market goes up in an escalator and comes down in an elevator, means that asset prices increase slowly, just like an escalator does. However, when it comes down extremely quick, just like an elevator. For example, the S&P 500 rose 921 points from the end of December in 2018 to February 2020. But in just 1 month, the S&P 500 fell over 1,000 points, just from mid-February to the end of March 2020. Let's look at another example of this. From the end of March 2018 to the end of November 2018, the S&P 500 rose 172 points. However, it fell over 340 points in just the following month, till the end of December 2018. Asset prices come down quicker than they rise for a couple of reasons. First, because many investors have margin accounts. These margin accounts let investors borrow money against their investments. However, if you use up most or all the money that the brokerage firm gives you, you can get a margin call asking you to liquidate some money to help protect the brokerage firm. If you get a call, you would have to sell your assets to provide liquidity. This often happens when the market is free-falling because the brokerage firm wants to try and protect their assets. This causes increased selling pressure, which contributes to the market falling quickly. The second reason is because it isn't human nature to wait when stocks are falling. For example, if the asset prices were crashing and you had a choice to wait a few days and buy an asset at $80 versus buy it now at $100, you would probably choose wait a few days and buy it at $80. So this contributes to falling prices as there are less buyers but the same amount of sellers, because who wants to catch a falling knife? When prices are falling, it is often referred to as a falling knife. If you catch a falling knife, you'll likely cut yourself and bleed. Similarly, nobody wants to buy assets that are in a free fall, because they will start losing money immediately. Nobody wants to buy assets when they're falling or catch a falling knife. Our next phrase is, emotions create commotions. Never trade on emotions. Never fall in love with an asset. Don't avoid an asset just because you don't like it. And similarly, don't avoid an asset because you've lost money before, because you've always made money on that asset. Always base your trades on data and analysis. If you trade on emotions, it can cost you money. Once again, never trade on emotions. Our next phrase is, plan the trade and trade the plan. Always plan your trades out in advance. This can be done by studying the data before making a trade. You can also establish a form or set of questions that you will answer before executing the trade. You should know what the reason is for entering and exiting the trade, and you should also determine what the entry and exit prices are, and the time frame before executing the trade. By answering these few questions, you'll be planning your trades out in advance. You should then follow and stick to this trading plan. You shouldn't trade your plan while in a transaction. Finally, you should review your portfolio periodically, no less than once a year. You should analyze why some trades worked out and some didn't, and you should also review the reasons why you're still in the trades that you are in. Our next phrase is, faster the speed, harder the brake, the bigger the accident. Price movements in markets are like train speeds. Try and think about a train for a moment. When leaving a station, trains speed up, but when arriving at a station, trains slow down quickly. Likewise, when the market is rallying, it will get faster and faster, but will slow down and turn negative quickly. When the train is leaving the station, it's easy to try and be able to get on the train. However, when the train is traveling fast between the stations, it is almost impossible to be able to get on the train. Similarly, when the market rally is beginning, it is easy to join the rally, but when the train is in between stations, you'll likely fall off and lose money trying to catch this train. So when the market is going faster and faster, it gets riskier and riskier to join the rally without falling off. The people who catch the train late or join the rally late are often caught hanging out at the door of a crowded train and are the first to fall off. Similarly, those that join the rally late will fall off first or lose money first. So when the rally is getting faster, you should consider selling your shares to avoid falling off. Another trend that occurs in the markets is mean reversal. Simply put, mean reversal is when asset prices fall back to the average price of the gain. Asset prices don't continuously move in one direction, as retracement occurs in between. For example, a stock in Nike can move from $100 to $120. In theory, the stock will fall to $110. Remember that this is a trend that commonly occurs, but doesn't exactly have to fall to the average. the stock price could fall to $108 or $112. Also, not every time a stock falls or NASA falls indicates that the asset price will fall to the average of the gain made. For example, when moving to $120, Nike could go up from $105 to $110 in one day, before falling to $109 the next day. Afterwards, the stock price could continue going up. However, if you see multiple days of an asset price falling, or a large drop in the price in just one day, it could indicate that it will fall back to the average price of the gain that was made. Our next phrase is, there is no such thing as free lunch. There's also a phrase that is often used in investing. If you are getting free lunch, someone is paying for it for you to be able to get free lunch. Whether it is the company, a person paying for you at a restaurant, someone is paying to give you something. In the markets, every day there are analysts giving free advice or recommendations to you. These analysts are giving ratings or views on a specific asset. However, these recommendations are often based on their own self-interests. They don't really consider what may be best for your self-interest. Additionally, you will notice that there will be multiple analysts giving different advice on a single asset. For example, one analyst may advise you to sell Apple, while another analyst may advise you to buy Apple. This can prove to be very confusing if you're trying to listen to all these different analysts, and could even cause you to make an ill-fated decision. All this advice and recommendations can create too much noise, which will cause confusion for new investors. Remember, the free stuff in life often comes with the biggest costs. Free stuff comes with a bigger cost than was ever imagined. So it is best to avoid listening or acting upon these analyst recommendations if you're an inexperienced or new trader. It's best to avoid these recommendations and act upon what you believe is right based on your data and analysis that you did, at least until you gain more experience in the markets. Then, you can try to understand why these analysts are giving that recommendation. The next idea we're going to talk about is memory pillow. In the markets, your past performance does not guarantee you a future return. Every day, the market trades on factors for that day. In the markets, the trends or occurrences of one day doesn't mean anything about what the trends will be for the next day. For example, just because the stock market has declined for 5 straight days doesn't mean it will go down the next day too. History doesn't repeat itself in the markets. What one day's trends are doesn't mean anything for the next day or for the future. The markets are not based on the past. They have no memory of the past. Our last phrase is, booked profit is better than paper profit. You should always try to book the profit when you can in the markets. This is because profits on paper can quickly disappear in just one day, but the book profits can never disappear. Additionally, you can only pay tax on the booked profits, not on paper profits. However, you must remember that paper profits can disappear and turn into a loss even within a span of just a few minutes. So you should always take your profits whenever it is possible. So that will take us to the end of our lesson today. So thank you all for joining me today, and I'll be making more videos about investing in the future. In fact, my next video will be about 5 things that you did not know you could trade or do with your brokerage account. So make sure to like this video and subscribe to my channel to know when that video drops. Thanks everyone.